Okay, time to answer some questions. I have been through, not all of them, there's a lot. I'm going to try to get through all of them. A lot about Tesla. I guess the Tesla fans pushing back against my analysis of Tesla and their position. So I'll answer the first one, and I'll answer it very comprehensively, and I'll lay out the case for the way I look at it. You can look at it differently. That's what makes a market, right? We don't all have to agree. And I'll clear up some things that I think Tesla shareholders might have blind spots for. With that, let's go. Undeniable that governments with a high debt burden will resort to increasing their tax bases. But specifically, the buy, borrow, and die strategy so far has been out there as a sort of loophole to significantly lower one's tax liability. That's not a loophole. Anybody can do it. Everybody does do it. I'd say almost 100% of the population does this, right? What's your stance on taxing unrealized capital gains? I think that's a silly thing to do. It's a silly thing to do. It would force you to sell assets to meet an unrealized capital gain. And I mean, how do you build businesses if you have to continually sell them off? This is an Ayn Rand Atlas Shrugged kind of moment where the government steps in and forces you to give away your ideas to other people. This is dystopian all the way. The fact that inheritors get a step up in the cost basis, for example, that was not meant to help rich people. That was meant to help poor people, or not so much poor people, but cash poor people and property rich people. That was meant to help them. So the borrow part. You do this all the time. When you get a loan, that's not income. That's not income. It's a loan. It's a liability. You got to pay it back. And you pledge an asset when you get a loan. You want to buy a house, you put some money down on the house. You go to the bank. You say, "Look, I'll put the house up against a loan against the house, a mortgage." And the bank says, "Yeah, we can do that." Well, the mortgage that you got, what if you had to pay tax on that? What if you got a $500,000 mortgage, and in that year you had to claim it as income and pay tax on it? You would say, but I didn't make this, I got to pay it back. It's the same thing if you decide to get a loan and you post shares of your company as collateral. You get a loan. What's the difference between the average person getting a loan and a rich person getting a loan? Unless you think that, no, there should be different laws for rich people. That it's not, everybody is subject to the same laws. We should have a different set of laws for those who are wealthy. It should be more stringent. They should not be allowed the same freedom that other people are. That's what you would be saying. As far as the step up in cost basis, you worked in your family business for years, and it is a family farm, and it provides basically a subsistence living. You make maybe $100,000 on the farm. You're doing okay, but you're not doing really great, and you inherit it. And it has a value that would cause you, because you haven't built up the cash reserves for it, that would cause you to have to sell it just to pay the tax, right? That's what it was meant for. And if you say, well, the rich people are using it, but it's a law for everybody. Everybody can use it, unless you're suggesting that there should be different laws for different people. If you're suggesting that, then you should own that and go ahead and say that the rich should not be allowed to do things that most common people are allowed to do. You have to own it and say it. But this is stuff that's available for everybody. Just because somebody with wealth is in a position to say, "Oh, I can do that easily." Think about it this way. Everybody, from the time they are born in America, everybody, from the day they're born, can go to university. Everybody can. There's nothing about your birth where somebody walks into the room and says, "This person can never be allowed to go to university, ever. This person can never be allowed to do anything more than grade 12. There's nothing that says that. It is the person's performance over those years that determines whether they can or cannot go. So let's say somebody really performed well and they have their choice of universities where somebody didn't perform and they don't. Should we then say, well, we have to ban universities because only the really successful students can take advantage of it? We wouldn't say that. So just because successful people are in a better position to take advantage of laws that are for everybody does not mean we should change the laws for those people just because they've performed better and are better able to use those laws. It would be like banning universities for people who had performed really well only because other people don't have access to university because of their performance. So I would say there is nothing wrong with these laws at all. I have to say I find GDP analysis super interesting from a KPI perspective. Never seen it that way. Really? I spent quite a bunch of time studying economics and you've never seen y equals c plus I plus g plus x minus m? That is, I think, the first week of a macro course. Totally agree that Tesla appears to be in trouble. That said, I wouldn't touch the stock options with 10-foot pole, neither would I. Tesla's investors aren't connected to reality. Well, they're not connected to a reality outside of Tesla. It doesn't appear that any amount of reality can dissuade them from investing in the company. Here's the blind spot, and I'll comment on this once, and then, because there's a bunch of Tesla, well, why don't you, full self-driving, why don't you try a car, all of this kind of stuff. So I'll just comment on it once. Tesla has competition. Full self-driving doesn't belong to just Tesla. Tesla's not the only one doing it. Tesla's not going to be the only one that's going to get it done. And there are multiple ways to solve a technological problem. LiDAR and cameras are both suitable. Ford has decided to go with cameras. Tesla has decided to go with cameras. Other manufacturers decided to go with LiDAR. There is more than one way to solve a problem. Tesla wants to introduce a $25,000 car, and the market went crazy for it, but there are already $25,000 cars out there. Tesla's saying, with all the sub $30,000 cars out there, next year we'll show up with one. But there's already a whole bunch out there. GM will beat Tesla to market with the Equinox, which is launching, I believe, this spring. 35,000 less 7,500 rebate is 27.5. There you go. It is a sub $30,000 vehicle. The idea that because Tesla's launching a $25,000 vehicle that they're 100% of that market is ridiculous. They're not going to get that done in the U.S. The union is amassing an army outside their business as we speak. The union has Mercedes in May. I guarantee you sometime in the next year and a half, Tesla will fall to the union. Their productivity isn't as high as, when I say productivity, their margin per vehicle is not as high as GM. GM's margin per vehicle is about 4,200. Tesla is about 3,000. Ford's about 2,700. These are the latest numbers. You can't go back 2 years ago and compare the numbers 2 years ago. Tesla is being pulled down by gravity to the margins of the industry. That is going to happen. So they're going to have to get this done in China if they want to be profitable on it. And there's already lots of sub $30,000 vehicles in China with great technology and great design, and a country with overcapacity at this point. And the auto industry has always been known for overcapacity, always been known for it. So they're going to enter into a low margin, highly competitive space. I don't know what the excitement was. I don't know why you went from a ridiculous valuation to an even more ridiculous valuation on that. Oh, it's full self-driving. Well, they're not full self-driving at this point in time. And there is, and I'll say this once, I don't want to repeat myself again and again on this point, there is a huge gap between 90% and 100%. A huge gap. You can start, developing autonomous driving and you can get to 90%, I think, in a fairly decent amount of time. with some stumbles along the way, but you can get there. Every point after that becomes much more difficult. And standing in between 90 and 100 is the reluctance of the insurance industry. There was a report out, they had investigated full self-driving. The Insurance Institute of something investigated full self-driving to determine where the risks are, and they noted that they are far more riskier than drivered vehicles, and all of them scored low. Don't look for the insurance industry to start insuring individually owned robo-taxis anytime soon. And lawyers, in 5 years from 2018 to 2023, I think there were something like more than 900 crashes with Tesla's autopilot, 29 deaths with autopilot. Each one of these comes with an army of lawyers. There is an army of lawyers between 90% and 100%. And you think on August 8th, you're going to suddenly have a robo-taxi in your driveway and you're going to send it off driverless to start making money for you? One accident, and you're going to lose it all. You're going to lose it all. And your insurance company's not going to cover you. You're not going to get insurance coverage. And if you don't tell your insurance company and there is an accident, you're not going to be covered. And God forbid somebody gets hurt or gets killed, say goodbye to everything you own from here on in, and say goodbye to all your future earnings from here on in, all your future income from here on in. There is a big gap between 90% and 100%, a huge gap that's going to take a long time to overcome. And as far as autonomous driving, Tesla's not the only one working on this. It's not as if, they announced it, it's all theirs, it's their market, it's 100%. They will be a player in an industry characterized with everyone doing this. Mercedes is already ahead of them. Mercedes was the first car company in the US to sell a level 3. The first one. Tesla's not level 3, they're level 2. So again, you may say, the experience is amazing. Yeah, 90% is amazing, but 100% is what you need. 100% is what you need. Ford, what do they have? 2 deaths, both with the Mustang. 2 deaths, and an army of lawyers have shown up. That's what's going to happen. There's an army of lawyers out there waiting, and they would love nothing more than hundreds of thousands of people to turn their Teslas into self-driving cars, because the numbers say there'll be accidents and there'll be deaths and there'll be lawsuits, and you will lose your house, you will lose all your future earnings, you will lose anything. I think the number is $1,400. You're allowed to keep $1,400 a month to live on, no matter what you make. If there's a judgment against you, you lose everything beyond that. Everything. That's you're basically buying an anti-lottery, right? Where if you win this anti-lottery, you lose everything. That gap right there is going to take a long time to fill. A long time to fill. And everyone's working on this. Everyone's working on this, and people are leaving Tesla. The executives are fleeing Tesla. Well, what does that tell you? There's something going on. And I think just this morning I read that Tesla laid off its entire supercharger team, like 500 people. The whole crew that was in charge of the superchargers laid them all off. What was that all about? So understand, when you talk about Tesla and what it's doing, everybody's doing that. And lots of car companies, especially in China, are already way ahead of Tesla on this one. Already have vehicles in the market. Everybody's doing this. There is nothing about Tesla that says they'll have 100% of this market, but investors keep thinking it'll only be Tesla. It'll always be Tesla. Only Tesla will have it. They'll have 100% of the market. There's no competition. There'll be a robo-taxi on August 8th. There'll be 1 million cars on the road August 9th, and they'll be doing $50 billion a year by August 10th. No. What you're going to see on August 9th are some pictures. And you're going to see pictures of an app interface of this is what the ride-hailing service will look like, and this is how you'll make money. And here's another picture of something else. But you will not have a robo-taxi service. You got to get that past municipalities, you got to get that past regulators, you got to get that past insurance companies, and you got to hope to God you avoid that army of lawyers out there. So we'll leave it at that. The Applied Series Q&A now take place? No, I think I'm going to cancel that. It has never had really good take-up. It's not exciting to do because there just aren't enough people on take-up for this. So I'm going to have to find another alternative or something else to do. But it just doesn't have the take-up that I need to see. Given the numbers that we have, even at 3%, if 3% showed up, the numbers should be significantly higher, but they're not. So I am gonna figure that out. I personally disagree with the negative beta outlook for the market. Well, I took a negative beta position on Monday. Tuesday, the market was down, 90 points? It's Wednesday morning. Let me look over here. Where is SPY? SPY is down another $1.61. So market's down another 16 points in the morning, sitting at 500. So, I'll take the victory so far. This market clearly wants to go up. Clearly it wants to go up. If it clearly wanted to go up, it wouldn't be having trouble right now. I don't know that it clearly wants to go up. The market has been going up. I don't know that it clearly wants to go up. It's exceedingly rare that during any given year a market top is reached in March. This technical stuff. If I look through history, no market has ever topped in March or April, so it's not going to. We can skip a lot of this. Market tops usually come in January and keep going. I'm selling out of the money puts on SPY when there's a down movement that spikes volatility, buying out of the money calls. That's the general position where it seems to be consolidation or move down. Okay, well, yeah, you just disagree with the position I have. That's fine, but I don't know that I would base my whole thesis on market tops are rarely reached in March or April, but I mean, if it works for you, it works for you, right? Still gonna, this week in CFA stuff videos. No, I'm going to cancel those. The first one I did had good viewership, and then it went straight down every week after that. And once you have something that you put up and in a week you get less than 2,000 views on it, there just isn't a market for that. It's that you could be spending your time on something with higher value that was more valuable to more people. I don't know that there was a market for a weekly video on CFA. It was interesting, I think, the first couple of weeks, and then interest sort of faded away on that. But this is what we do. You try new things, and if it doesn't work, you move away from it, right? You try new things. It didn't work. So, it didn't work the way I wanted to see it, so I don't know that I would continue with that. Oh my God. Come on, man. What do you got here? You're smuggling in, 9 questions in one? I don't know if I'll get through the whole thing. Let's just answer a few. Noted IBKR TLT continues trading after Friday at 4. You can trade all the way to 8 o'clock at night. And I believe that Interactive Brokers has introduced 24-hour trading for some ETFs, for some big ETFs if they have volume. When selling puts on TLT, you also pay attention to delta being around 0.2. No, not really. I look for levels. The reason I asked that you mentioned you'd be okay with selling 90 puts, you currently have a 0.5 delta. TLT this morning is at 88.01. Could be an ugly day for TLT because there's a lot out today, including the Fed. Any push down on TLT, I'd be looking for the 85s. If you say you're looking at selling 90 puts, current premium, let's just skip here. Where's the question? Okay, logic behind. Well, 90 was when it was there. Now it's at 88, so no, I can't answer that because that's history now. In respect to return, if you had a chance to invest in some sort of bonds that generate a post-tax return of 5.5 to 6 but no cap gain, would you rather go for that versus TLT? a post-tax return of 5.5 to 6, I would have to be taking on risk. I'd be investing at my tax rate to end up with 5.5 to 6. I'd have to be getting 11 to 12%. That's a risky bond. There's no guarantee I'm actually going to get that money. No capital gain. Would rather go for TLT. I'd probably rather go for TLT. But, it depends on what bonds you're bringing me here. In one of your recent videos, you mentioned you bought, 5.5 to 6, but no cap gain component at all. This is all you get is an income component. No, I'd rather go with something that has capital gain. If there is no capital gain potential to this, that is just an income component. There'll be no active options market on that at all. So I don't want to touch that. 25, 30-year individual bonds. Are these corporate or government? They're government. Did you buy them directly with options? Nope. Did buy them directly. Bought them directly. Yep. It's possible. That's how you found them. Interactive brokers. There is a button. Let me just click down here. It is called Treasuries. You just click on the top menu where you have all the icons. There's a little arrow down button. If you don't see it, you click on that. Another menu pops down. You'll see Treasuries. Click on that. Find the treasury you want, and off you go. When you mean liquidity in the context of trading options, you're referring to volumes of shares bought, sold? Well, more volumes of options. Where do you get that info from? Right off my screen. In Interactive Brokers, click on Options Trader, and it'll give you volume, and it'll give you open interest on each strike price. What determines whether a company stock has got options or not? Depends on the interest in the stock. Some stocks at IPO get options almost right away. Others take years to get options. Some stocks have options where they shouldn't have options because there's no liquidity. I'm not really sure what determines what gets them or not. Gold, copper, how do you find your targets? Just research. There's only so many companies. Would you go to the S&P list of filtered by miners, then start collecting basic financial spreadsheets and narrow down the list, say 2 to 3? No, I'd go to an ETF that tracks gold mining companies or copper mining companies. I'd look at the list and I'd start with the biggest. The biggest usually is the biggest for a reason. I'd start with the biggest. And then maybe look at the second biggest to see how that one compares. But usually it's the biggest one on the list. Freeport, biggest copper miner. Newmont, biggest gold miner. You grab the big ones. I started researching myself and bumped into a company called B2 Gold. Yeah, I'm familiar with that one. These guys got 4 mines. Yeah. All-in sustaining costs $12.57, significantly healthier than Newmont at $14.44. Production levels seem to be going slowly. Okay, blah blah. Dividend. Yeah, okay, you're making the case for it. 2 things I'm not able to work out: reserves, returns disclosed in the report. They have to be. Hang on a sec. That's an SEC regulation. If this is a South African mining company, it might be more difficult. Barrick was difficult, but you can find it. So if you can't find it in the 10K, or the 10Q, which it should be in there, you just maybe have to search the document for either the acronym 2P, or for reserves, or for the word proven. If not, go to investor relations at the company site and look for their most recent investor presentation. I don't know how a mining company can present itself without presenting its reserves. That's critical. Huge unrecognized deferred tax assets. Nothing wrong with that. Nothing wrong with deferred tax assets. GM has big tax assets as well. There's nothing wrong with that. Due to uncertainty around future profits and also massive non-capital tax losses. If you're not familiar with this company, okay. What other analysis would you perform before entering in any trades? I don't do a lot of analysis. You know, I don't know that it's worth diving into the numbers that much because the numbers represent the past. I don't know that it's really worth digging into these things. I want to know what the plan for the future is. How much gold do they produce a year? What is their all-in sustaining costs? What are their plans for increasing production in the next few years? What are their plans for reducing costs in the next few years? That's what I want to know. And if they have no plans, or if they have costs that they're projecting going up, and production flat, yields declining, and because mines do get to that position where there's nothing you can do about a mine. Its yield is going to decline and its costs are going to go up because you're digging deeper and deeper for that ore, right? There's no way to avoid some of these things. So I look for the story going forward. What makes me think tomorrow or next year is going to be better than last year? And what does that is increased production and an eye towards decreasing costs. If you can increase production and decrease costs as a mining company, there you go. The price of the commodity will be the price of the commodity. There's not much you can do about that. How much weight do you give to technical analysis? Nothing. I give no weight. And you mentioned a few patterns and moving averages from time to time. Yeah, just the big ones, the obvious ones, trend lines and moving averages. Not that I believe them. Not that I think that there's any reason why investors should bet billions of dollars on a company simply because you drew a line on a chart. I cannot come to that conclusion that you show me a chart and you say, look, I drew some lines on the chart. The lines say the stock is going up. It's okay, give me a break. Lines on charts. You know, the future is unknowable. No matter how you try to do it, the future is unknowable. But a lot of people follow it, and I'm not about to dive deep into the madness, but there are a couple, any technical analyst is going to have trend lines and moving averages, along with all the other tea leaves that they like to read. They're going to have at least that. So may as well look at that. You know, what are the crazies looking at? Because they will act as if it were true, and it's the action that has impact, not the line on the chart. But no, I don't think much of technical analysis at all. I think those who can't do fundamental analysis do technical analysis. What do you think of the idea of cheap oil has ended, and this means that the period of deflation is over? Well, the cost of something has nothing to do, I shouldn't say nothing to do, has very little to do with inflation. You can have costs rising, but if productivity rises even faster, then you have deflation. And that's what technology will do. Technology increases productivity. So if we look at the cost of oil and you look at the EPA requirements for fuel efficiency and for emissions from the 2027 to 2032, they got to be cut in half. They've got to be cut in half. So the fleet has to change. It's not per vehicle, it's fleet-wide. The fleet has to change such that the fleet is using half, is getting twice the mileage it currently is getting now. So even if the price of oil goes up 50%, but you're using less of it, you're still more productive. You could still be at a cheaper cost per average mile driven. In the US, if you look at the cost of energy for each dollar of GDP, it's been going down. Even in China, it's been going down. It's at a higher absolute level right now than it is in the US, but it has been going down. So the productivity of the economy is increasing to the point where the energy required to produce a dollar of GDP is getting to be a smaller and smaller proportion of that dollar. So the cost itself isn't as important as the trend in technology and productivity. So you can say costs of something are going up. Great, that is only going to induce more innovation to avoid that cost. The higher costs go, the more companies will work to find a way around that. If you want to, it was John Hicks, 1932, induced innovation. made the argument that as costs go up, companies are induced to innovate to avoid it, and that is a source of innovation is rising costs, so that we should not be afraid of rising costs. Rising costs actually provide the ground for innovation. When I did my dissertation, one of the things that I looked at is this. You remember the Phillips curve, right? Where you have a trade-off between inflation and employment. So if we put employment here and you put inflation over here, the higher inflation goes, the lower unemployment would go, because the central bank would be raising rates to lower aggregate demand to try to get inflation down. Well, if you turn this into a grid, what I did was I took the top, the 1% of the most cited patents in the U.S., and then I mapped them onto the Phillips curve to see where they occur. Right there. That most of the significant innovations, most of them occurred in high inflationary periods at the top of business cycles, not at the bottom of business cycles, not after rates, not after the economy was crushed to kill inflation. In other words, the free market, through innovation, is going to take care of inflation faster than the interest rate can. And by raising the interest rate, what you're doing is you're making the cost of all of these projects higher. Sorry, not higher. You're making the net present value of all these projects higher. And you're actually killing the very grounds of innovation that we need. The best cure for high prices is high prices. And in a country like the U.S., which has a lot of capital and an entrepreneurial spirit, there is no reason that the interest rate need do the heavy lifting on this one. Innovation will do it, but innovation gets expensive as you raise the interest rate. So you're actually killing the very free market mechanism that will solve the problem that you think you're solving. The best cure for high prices is high prices. Are you still planning to set up a website to alert users automatically when videos get added? Hard to get done because the website's not mine. It belongs to Serify. So I don't have power over the IT people or what can get done. But we're going to use Instagram and X. And every time there's a new addition to the Applied series, we're going to post it on Instagram and X. So all you have to do, there'll be an Applied level account for each one, is you simply just subscribe to the Instagram or X, and we will only use it when there is new content to be added. So it's not as if I'm going to hit you up 5-6 times a day with a new post. It'll only remind you or alert you when something new has been added. I think the excitement, value, appreciation, autonomous driving plan. Okay, so we can skip all of this. I have addressed that. This last one where it says go test drive a Tesla. Why just a Tesla? I have no doubt that I'd sit in it and go, this is kind of neat. Yeah, I'd have no doubt. But there's a difference between this is kind of neat and this is ready for mass production and everyone will be driving. There's a big gap between those two things. And I would say go drive a Mercedes. Go drive any vehicle that has level 2 or level 3 autonomy in it. Go drive anyone. Why just stick with one? It would be like me saying, have you tried these chocolate bars? Go try a Snickers bar. Just go try a Snickers bar. I think you'd answer and say, but there are many chocolate bars. There are lots of chocolate bars out there. But I'm so hung up on Snickers, and I think that Snickers is the only chocolate bar out there, and it's the only one with chocolate and nougat and peanuts. You got to try the Snickers. Have you tried a Snickers lately? It's like, but if you go and have a look, there's more than just Snickers bars. There are other ones that you may try and say, hey, this is actually better than a Snickers, isn't it? It looks, and it's a better packaging, and it feels better. Q1 earnings last week, agency, what the CEO means when setting their dividend policy based on ROE, cost of capital, leverage. I don't know. I didn't read any of that or hear any of that, so I can't comment on that. Isn't agency's earnings more than cover their dividend? Well, when we say what they're getting here, this is a revenue number, not a net income number, right? And isn't REIT supposed to pay out 90% of their income? It's supposed to pay out 90% of their taxable qualified income. Their taxable income. I don't know. I don't know. I didn't hear, read, or see anything like this. So, make an understanding video on mining royalty companies. In time, I will get to most of them. Complement sector studies. Reading Moody's sector scorecard and or reading Moody's report for biggest companies in a given sector. Is it useful? Yeah, sure. Sure. Does the fact that Moody's focused on credit side of the business's value for retail stock? No. How are you thinking of ending your short beta position? Selling futures again? Pretty much. Duration struggling, beta struggling, where to find diversification? Gold, oil, floating rate debt. Do you see the yield curve becoming uninverted? What happens when it occurs? Yeah, the yield curve will become uninverted. That's not the interesting question. The interesting question is, how will it become uninverted? That's the more interesting question. Where to find diversification? You could find that everywhere. There's every company you look at is either a buy, a sell, or a hold. Every single company you look at. So just pick a company, any company, spend 2 weeks with it, really get to know it, go through its 10K, go through its most recent 10Qs if you have them, go through the investor presentations, listen to some of the conference calls. Listen, pulling up a 10K, running to the balance sheet or income statement, looking at the net income and spending 8 or 9 minutes looking at it saying, okay, I think I got it. No, you don't. No, you don't. You don't have a story. It's 2 weeks. Okay, you got to think about this as an undergrad paper for a capstone course, which is going to take you, normally you do it in group work, but it's going to take you 2 weeks of 5-6 hours a day and a lot of Google searches to figure out what this means, what that means, maybe a discussion with somebody else to say, I can't figure this out. What do you think this means? But 2 weeks with a company before you can really understand what its future is going to look like. And then you're ready to put it into one of those 3 buckets. So, but every company I look at ends up in one of those 3 buckets. But there's lots of places to, I don't know if I'd say diversification, but there's lots of places where I can find a trade. Read an article about $1.7 million public toilet. I just don't understand how something like this would cost that much to build besides corruption. Not in the U.S. I'd be less likely to say corruption in the U.S. I'd be more likely to say regulation and just general stupidity. You want to put a toilet somewhere, you're going to need some kind of consultation about where you're going to put it, what kind of access you're going to have. That's going to cost money for those consultants and those civil engineers. Then you're going to need an environmental impact study of putting it there. Then you're going to have to poll the community and the neighborhood, and you're going to have a few public open meetings to discuss the impact of them being there on local business and any residential people in that area. Then you got to get the permit to build it. Then you have, like, it's something like 50 or 60 different permits that you have to get to clear everything to get it done. That's why you cannot build affordable housing in San Francisco. Simply because of just the pure amount of regulation you got to get through, the time it takes, and all of the studies that you need done. You simply can't get it done. You can't build it. Previous Q&A, you were not thrilled with FCX Q1 earnings. Or was it guidance? It wasn't so much guidance. It was what they based the guidance on. So I want you to think about this. Let's say you're selling puts on gold. You sell one at 2,300. You sell another put at 1,900. You can either sell at 23 or at 19. Which one's the riskier one to your profit? It's the 23, because that's where gold is. Any movement down under that, you're going to underperform right away. but you're going to outperform still at 1900. So Newmont forecast ahead using $1,900 an ounce. FCX forecasts using $2,300 an ounce. Well, it's more likely that they're not going to meet their forecast because they're using an at the money number. It's like selling an at the money put. It's going to be more risky. Whereas, so if this drops down to 2,100, if gold drops down to 21, they're not going to make those forecasts. Whereas if it drops to 21, that's still $200 an ounce above Newmont's forecast. So it's their forecast was based on raising the realizable value of their metals to the market price. That's not really a wise thing to do. That leaves you no room. That means those metals must go higher for you to beat your forecast. They must go higher. If they go lower, you're not going to meet your forecast. So there's a higher probability Freeport will miss their next earnings than Newmont will, simply because of where they priced the minerals for their forecast. Pricing it at 23 an ounce just doesn't seem to make a lot of sense to me when it's at 23. One point about reacting to data points and going from one to the next. Has it always been this way? To some degree, but not to the degree that we have today. To some degree, there are some data points that matter all the time, depending on where we are. PMIs may matter the most. That may be the most critical thing. Other times it may be the jobs numbers. Other times it might be initial claims that are the big number because we're worried about something. But now it seems that every Fed meeting is the most important meeting. Every jobs report is the most important jobs report. Every PCE and CPI report is the most important. Every report seems to be the most important one we've ever had. That's kind of recent. There were almost a whole decade there, 2010 to 2020, where no one really cared much about the Fed. Like it was like, nothing much going on. Fed days would come and go, and I wouldn't tune in and be like, well, for what? They're going to come out and say nothing's changed? So no, not like it is today. Meta earnings and their CapEx. I think what they're worried about here is that Meta's entering another metaverse phase where they're going to overspend on something, fall in love with something. I spent some time with a bunch of AI models in the education space over the last week. I think I looked at 5 different ones, and I looked at one from finance that produces like 10 years of data. I think it's Otter AI. No, not Otter. Otter does recording. You can record your meetings, and then it'll summarize your meetings. I didn't really play with Otter. Sorry, not that one. I forget which one it was now. But I played around with these. So for this one over here that provides 10 years of data, I put in a company that I was well aware of. Wrong. Like it had all its lists wrong. Yeah, okay, wrong. So right away it was wrong. And I was well aware of the company. I was looking at the most recent quarter, looking down, going, no, that's all wrong. It's all wrong. Because the person who programmed the algorithm doesn't know where to make the decisions. It just says, take from this line, take from this line, take from that line, here you go. It was apparently AI generated, but it looked like nothing more than an aggregator to me. And I thought, well, that's not really AI. Looked at the education ones. And being that I know a thing or two about education, I decided to put them through their paces to see what I would get. One of them, you can't really get very far. It kept saying, that with one of them. I was trying to use it, and it's just not available in Costa Rica. And it said, we're working on getting you access. So I'll wait till I get back to Canada. The other ones, I asked questions, and it was, okay, well, this is you can find this on a Google search. What have you really given me here? I wasn't impressed on any of it. I'm still looking for something that I could potentially use on my own site, and I haven't found anything yet that can do anything more than report back words that it's seen somewhere. As far as generating new knowledge, I'm not seeing that it's doing that. So I'm generally unimpressed. And again, it's that difference between 90% and 100%. that you can impress a lot of people with 90% of the job. But when you need it for mission critical stuff, you need 100%. It's not there. And I think it's going to be quite some time before we're there. But we are at 90%. And I think maybe in a year we'll be somewhere around 91%. Another couple of years we might be at 92 to 93%. 100% being this is it. This is it. This does it. Look it. It does everything. I think it's going to be a long time to get there. And being that they're spending so much on it, I think that might be the concern, that this is another metaverse. Cash flow being low for the quarter. This is an event, not a trend, as you would say. Arson attack, Red Sea. Okay, this is the Tesla thing. It's always, I don't know why, but with Tesla, no matter what happens each quarter, but you gotta look past this. You gotta look past that. You gotta look past this. So if you look at adjusted, right, adjusted EBIT, what you get is you start with net income, you add back taxes and interest, you take off interest income, and you'll get to EBIT. And then you have all your adjustments. These are all your one-time things, 2023. And the argument each quarter is you got to look past these things. Go to 2022 every quarter. Yeah, but you got to look past these things. Go to 2021 every quarter. Yeah, but you got to look past these things. These are all one-time events. But when a company produces one-time events every quarter, that's a trend. It's a trend of one-time events, right? If you're looking down at the adjusted EBIT and it's not EBIT, that means you've had adjustments. And if every quarter you have adjustments, you have all of these one-time things that you have to look past, at some point you got to say, well, hang on a second, are we just not going to have more adjustments next quarter? Yes, you will. But they're hard to predict what these one-time events are, but in aggregate, you can predict that there will be one-time events. Much like an insurance company that insures 100 people doesn't know when this person is going to die, but statistically on the group does fairly well. Well, you're not going to know where the one-time event is going to occur, but statistically, I can tell you there'll be one-time events. So you can look past each one-time event, but you can't look past one-time events. They're going to occur with regularity, which makes them a trend. There is a trend in the one-time events. Treasury conducts refunding, issues new securities across various maturities, short-term, longer-term. Scenario where Treasury is issuing new debt to replace maturing securities. Well, when you say scenario, that's not a scenario. That is what they do. That is what they do. They don't pay off debt with cash. They pay it off by issuing new debt. Increased supply of two-year treasuries can put downward pressure on their yields. Sure. Alternative is market is absorbing new supply. Can this lead to lower prices? Yeah. If demand doesn't match the increased supply? Yeah. How sure can we be that supply meets demand? You can't be. And not to create a surplus of two-year treasuries that ultimately leads to higher yields. Well, that's a market. That's the market. Market participants may interpret the Treasury's actions during refunding as a signal of expectations for future interest rates and economic conditions. If the Treasury is issuing a significant amount of short-term debt, it could imply that policymakers expect short-term interest rates to remain low or even decline in the near term, which can influence market expectations and impact yields on two-year treasuries. Okay. Yeah. Basically, what you've described as a market. You say, how can we be sure? You can't. There's nothing you could be sure of. Well, the only thing you could be sure of, fairly sure of, is if you buy a two-year treasury at 4.9%, it does not matter what happens to the supply or demand. It does not happen to the yield. You will get 4.9% and all your money back. So all you have to say is, am I comfortable with 4.9% over 2 years and all my money back? And if you are, then what does it matter? Right? That's all you can do. Tesla, okay. And data sleeve. You mentioned selected targets may not be good candidates every month. Correct. Is there a certain ROI that you try to achieve with each option? Not really. But I mean, I do look at that. I mean, if I'm going to get 43 cents, but I'm required to post $10,000 for $43, I'm not interested. right? I mean, I do pay attention to it, but not religiously. What price does GM need to drop before you sell 43, 42 put? Well, it's not just what price does it need to get to. It's also why did it get to that price. So it's not as if I'm just watching the price. I see 42, I sell puts. If I see 42, I ask the question, why is it at 42? And if it's because of general market weakness, because of some concern about something, well, okay, that's fine with me. But if GM came out and said we're lowering our guidance we had for the year, well then 42's off the table at that point, because the market is responding to lower guidance, right? So I may move down to 38 and say, given the new lower guidance, I'll sell puts at 38. It's not just if it moves down, it's why does it move down? That's a big thing. You have to be prepared to say, well, the why is more important. And it got to my target price, but for the wrong reason. I'm not touching this thing. And as far as where I sell puts, it's more of a intuition, more of a feeling. A good analogy I can use is with a carpenter or a cabinet maker or a furniture maker. You can teach somebody how to work with wood, but it takes years to feel the wood. That when you pick up a piece of wood and you're doing something with it, just the way the grain moves and the way whatever. I'm not a carpenter, so I'm just going to make stuff up. The feel of the wood, the look of the wood, the way you're working with the wood, the way it's bending or curving. Somebody who's been working with wood a long time would know the characteristics of that wood without really being able to explain it to you. There's some kind of tacit knowledge that they have. It's the same in markets, that you can teach up to a certain point, but after that you need experience. You need to build that tacit knowledge inside, that when you look at something, you have the theory of everything, you have rules and you have a process, but there's also a feel you get where you say, let's move it down $2. It's just the way the market feels. I don't know if that makes sense. Signed in, checked the website. Couldn't have found applied gold mining. Sector studies, materials. Inflation, currency rates. How would you in a practical way do analysis of how they correlate? If you tried to do an analysis of how they correlate, whatever model you built would be misspecified right away, because there's a mediating variable. Mediating means it works through another variable, which is the interest rate. So you would find that inflation and the interest rate are correlated, the interest rate and currencies are correlated, thereby making you think that, well, it works in a transitive way, that inflation and the currency is correlated, but you're missing the mediating variable. It's the most important part. So I don't know that I would look at the two of them together. I would look at their relationship with the interest rate, and you would find nothing really interesting. You'd say, well, okay, they're correlated. Yeah, yeah, that's it. So I don't know that that there's, it would bring you down to predicting what the central bank will do versus what the central bank in the opposing currency will do, and what the interest rate differential will be. Does the UAW try to unionize the company's entire workforce, just factory workers? Typically the hourly employees. Tesla's factory workforce only accounts for 20% of its total workforce. That's common. Smaller proportion compared to other automakers. Doesn't matter what the proportion is. It matters what the proportion of cost happens to be. You can use fewer workers when assembling an EV versus an ICE. It's a function of the product you're working with. So GM reports, if you say, well, there's 20% of its total workforce, but that 20% is in assembly. That's the important thing, right? So a couple of points here. GM reports that 66% of the cost, its automotive costs, are for actual materials and parts. 34% is for labor, depreciation, amortization, factory overhead, things like that. Labor actually is a very small part of the cost of assembling a vehicle. less than 20%, much less than 20% of the cost of assembling a vehicle. So even if you raise that cost by 20%, it is a small cost. It can get done. And the auto companies are sort of have a good relationship with the UAW in this sense, is that GM will say, look, we can pay more, but what are you going to do to increase productivity? We have some ideas of how we can increase productivity. We need you to agree to it. And if the union agrees to certain measures that the company wants to take, saying, okay, we'll agree to doing things this way and doing that and rationalizing this, GM then can say, okay, well, we can raise wages. So they get productivity increases out of it, which is probably why GM is more profitable per vehicle than Tesla would be. Tesla, you say 20% of the workforce, but that's all in assembly. So if we think about the cost of a car, there is something called absorption costing. So here is the assembly facility, and here are all your workers in here. And everything that goes in, all raw materials, everything, and everything that happens in here, all wages and everything goes into the cost of the car. So you have the car and you have certain cost of goods sold. This vehicle absorbs all of the costs of production while all the unions employees are right in there. So it doesn't matter how many you have or where they are. It matters what goes into the cost of the car. All of those wages go in. So you get a union, they all go up. What happens to the cost of goods sold? They go up unless you can find a way to increase productivity. So Tesla would then have to negotiate with the union and say, okay, well, our costs are going to go up considerably on that component. We have to get offsetting increases in productivity, and they would have to push back on the union saying, we can give you this if you can give us this. Do you agree to reduce breaks from 17 minutes to 15 minutes? Do you agree that the start time will be 7:35 instead of 7:39, and that people will leave at 3:10 instead of 3:05? Would you agree to that? Like, you got to try to get more productivity. You collapse the number of job categories. That's always a good one to increase productivity. Instead of having 39 job categories, see if you can't get 10 job categories, because then one worker can do multiple jobs as opposed to having different workers, right? So no matter what happens, their labor costs are going to go up, and it's those labor costs that go into the cost of goods sold. Engineers, management, everybody else over here, anybody software, anything working over here does not go into the cost of the vehicle. So what's going to get hit is gross margins, and you're still going to have these costs. And even with costs going up, it's going to be hard to increase your price in the middle of a price war. So it doesn't matter the size of it. It just matters that those people's wages are in the price of the car, are in the cost of goods sold. Lots of activity on these systems today. Interested in buying the Applied series. How difficult is it to understand, and how much value does it provide to non-CFA retail investors managing a small personal portfolio? I think it's extremely valuable. I mean, if you're going to buy a stock of something, you should at least understand the industry and understand the company. So I think it's extremely valuable. I don't think they're difficult to understand. I've gone through MIT's open courseware finance theory course in my free time. I have a math background. I think you'll be okay. Market data subscriptions you have for IBKR. Would you recommend for someone that would like live market data for U.S. equity markets? The live data for the U.S. equity, you get them for free if you generate trading fees over a certain amount. When I sell options, I'm selling 50 to 100 at a time. One trade more than covers off my data subscription because of the volume of, not the volume of trades, but because of the size of the trade I do. It generates a large trading fee. So I get data almost for free. Some data you got to pay for it because it doesn't have that, but all the U.S. data I get for free. Buying a house, not sure how much money I should pull out of my brokerage account to use it as down payment. Mortgage rates over 7%. I would be able to earn a higher return on my brokerage account than interest on mortgage. However, lower monthly payments also come with less stress levels. You're deciding whether you want to buy the house or, well, you can't think of the house as just a cost. You have to think of it as an investment. You're making an investment in an asset, an appreciating asset that has an income stream. What is the income stream? Well, you must be paying rent somewhere right now. Well, then you'll pay rent to yourself. If you have your own house, you get pay rent to yourself. So if you're paying $2,000 a month and your mortgage payment is $3,000 a month, you could say, well, I'm really only paying $1,000 a month for the house, right? I'm only paying $1,000 because I'd be losing $2,000 to rent anyway, so I'm really only paying $1,000 for the house. You could think about it that way. And if you have the mortgage, if you have the interest deductibility on taxes, which I think the U.S. has, I don't know if that's been canceled or not, but if you have that, then wow, you could end up in a better place. Now you have an asset that's going to provide you with a stream of income, which is $2,000 a month. You're paying it to yourself, but it's still $2,000 a month, and that asset will increase over time. So you have a cash flow component, and you have a capital appreciation component. Apartments don't have that. Apart from the yield curve inversion indicator, Fed holding rates too long. What is your thesis for short beta? Multiple is too high. It's just at a certain point, the price at which a market is trading at is unjustifiable, given where rates are. Just to sort of give you an idea of that, we learned this in level 1, right? There's the Markowitz efficient frontier, risk-free rate, and that line that's tangent. There is your optimal portfolio of risky assets. We'll raise the interest rate and draw your curve. The terrible drawing there, but what have I done? This is the capital allocation line. That's a Sharpe ratio, nice Sharpe ratio, pretty crappy Sharpe ratio. And what do I have to do to get that? I have to keep taking riskier and riskier portfolios to get that. And I'm getting a Sharpe ratio that does not really compensate me that much for taking on one more unit of risk. That's the point of the high risk-free rate, is like, why am I stepping out on the risk curve? Every increment of risk I get is just a really small return. It's really not worth it. When you have very high capital allocation lines, you have very high Sharpe ratios, a little bit of risk is a nice return. But here you got to take a lot more risk for the same return. Kind of deters you from taking risk when I can absolutely get 5.5% over the next three months on a T-bill. I don't know if I'm going to get that in the market. But if I can only get 0.2% on a T-bill over the next 3 months, I would say, I'm not getting anything anyways. I may as well take my chances. So, just a little bit of thinking, kind of clears it up, is that to get the return, to justify being in equities, I must move up the efficient frontier to riskier and riskier portfolios. The economy continues to add jobs, yeah. Continue to spend their large retirement savings, yeah. I expect payroll employment in these industries to remain strong. Okay, you suggest fiscal stimulus will continue and private non-resident capital spending rose to a record high. Yeah. All of that is true. I'm not criticizing any of that. Listen, I have a very nice house in Canada. It has a full commercial gym. It has a 4-person infrared sauna, 10-person hot tub, nice big saltwater pool in the backyard. Driveway parks 4. You got a car double car garage with a car lift on one side, so you can park 2 sports cars. I got a great house. I'll sell it to you for $50 million. At $50 million, you'd say, come on, that's ridiculous. But I'd point out, look at all the features of the house. Much like you're pointing out all the features of the economy, I'll point out all the features of the house, and it's well constructed. You can't argue with any of the features of the house. You would say it's the valuation I have a problem with, not the features of the house. It's the valuation, not the features of the economy. At some point, it's just too expensive. No matter how good it is, it's just too expensive. Would you sell ES or sell calls? Sell ES. If you manage, let's say, 25% of your money, you being short the market, at 100 delta is actually like selling 25 call, right? Correct. Shorting the market has been painful. Long duration has been painful. Yep. Although we understand the rationale behind these two trades, but they haven't been working out, shall we review and look at them from a different perspective? You have to be willing sometimes to outperform in the short term if you want to outperform in the long term. So if the end of the road is what matters to you, the pathway really shouldn't matter. So delta is underperforming, but if you keep interest rates high long enough, you will start breaking things. We cannot continue on with rates at this level and even going higher and that everything will be okay. You're going to break some things. Simple as that. You are telling people, especially those at the bottom who have debt, you're going to pay higher interest rates in the hope that we can get your other costs down, while the consumer would say, but I can shop around to get my other costs down. I can't get my interest rate down. So you're crushing them in a different way. That's all you're doing. If you have a crisis, duration is going to do very well. Beta is going to do very poorly. This is where you sell over here and you buy over here for the next run up. But you have to wait for this condition to show up. And if you can get this condition over here, over the long term, you will outperform. That's what I'm waiting for. And much like a hunter will tell you, waiting for the 12-point buck, you have to have patience. One will eventually come by. I have patience. The conditions are in place for something like that, and it's just a matter of having patience. Whenever you're short a put, do you always set aside cash to buy the shares? Not always, no. Do you still puts on those high dividend payers that you introduced a few years back? I left almost all REITs behind quite a while ago. Got out of almost all REITs. And only recently have I, except mortgage REITs, I stayed in mortgage REITs, but only recently have I been looking at residential REITs, and only in Canada. But I wouldn't touch office REITs, I wouldn't touch industrial REITs, I wouldn't touch, I wouldn't, retail, I wouldn't touch any of those. If and when, well, not if, but when Fed cuts rates, would the long end of the yield curve necessarily fall, making going long duration? It depends on how they cut and why they're cutting. Long-term rates around 4.5. Ordinarily, the yield curve is upward sloping, so short-term rates get cut. The long end may not move or even go higher. It's possible. But my end game is quantitative easing, a ballooning of the balance sheet past 10 trillion sometime in the next 5-6 years, and the Fed at the zero line probably for decades, because your government is not going to change their profligate ways. Neither one of them. I don't see any responsible government anywhere in the U.S. on the horizon at all. So that's the train that's driving everything now, and it is driving towards the edge of a cliff, and it's going full speed, and no one seems interested in changing the direction of that train. No one seems interested. So to afford all of that, the Fed will have to move to the zero line. They will have no choice. Any kind of interest rate would crush the economy, simply because of the cost of all the debt, and the extraction of all the taxes that the government would have to take, and even if they didn't do that, they would just deficit spend more, which would make the situation even worse. We're at the beginning of a very bad train wreck, and to avoid it, they will do what the Bank of Japan did in the 1990s, which is run to the zero line and hold it there for as long as they can. How long has it been now? How many years? How many decades? Weekly trades that you mentioned, they start in September, and they'll be in the portfolio construction series in the applied level. How would a really long-term investor construct a capital allocation model if his investments are mainly held to maturity? Investors are generally unconcerned about fair value metrics. Would the expected return on bonds be the yield to maturity? Nope. and the expected volatility and for some sort of default risk. Wow, your question is too broad to even begin to answer. I don't know what you mean when you say bonds. What kind of bonds? High yield, investment grade, government bonds? I don't know what you mean. And who cares about volatility if they're government bonds? If you're holding the maturity, what do you care about the volatility? So I don't know. I don't know how to answer this, but I'm not sure why your capital allocation model would be all bonds. You say investments are mainly held to maturity. Those aren't equities. There is no maturity for equities, so they must be all bonds. How would you construct a capital allocation model? I don't know. I am nowhere near. There's nowhere near enough information to answer that question. There's 100,000 different ways that you can answer that question, depending on what you're trying to get done, who you are, what you need the money for, what's your level of current wealth, what's your desired liquidity, what are your goals. There's so many questions before you can even come up with an answer for that. But the range could be 100% in money market funds all the way to 100% in the highest beta stocks. Anywhere between those 2 points is an answer, depending on the scenario. It all depends on the scenario. There is no one answer to a question like that. Difference between selling a put on TLT with December expiration versus going long futures. Opposite trade. They are completely opposite on a 30-year bond. If you're going long a futures, you want the price to go up, and you have a linear payoff, which means if it goes up, you make money in a linear fashion. If it goes down, you lose money in a linear fashion. Selling a put on TLT, if it goes up, all you can make is the put premium. You don't go up in a linear fashion. All you can make is the put premium. But if it goes down, at some point you start losing in a linear fashion. So one is a convex payoff. All this dinging. What is going on here? Let me just tap on that, because if I don't, it's going to ding twice to remind me that I didn't pay attention the first time. Yeah, so you have different payoff diagrams. Yeah, I think the first is that TLT has a duration of 17 years. Just wondering what you mentioned, the futures instead of the options on TLT expiring in December. Well, you're not going to get futures for December with any liquidity. Usually it's only the next month, or the front month. Back to short beta. Does the expected high deficit spending on election year give you any pause on those shorts? No. Do you think ABR is a better investment than agency? It's just different. I don't know that it's better. It's just different. ABR earnings are Friday. On the last earnings calls, they stay a quarter next, the most challenging. That will be in the expectation. The challenge will be in the expectation. So it's not as if they have to beat a number that suggests that everything was going to be great for them. The expectation going forward will reflect that challenge. You said you were looking at short beta. Nobody answered that. Prefer options for risk management, but for a smaller portfolio, limits the security selection. Do you recommend building a portfolio by buying shares, or continue building the portfolio with an income strategy until options can be used? I don't know enough about you to even begin to answer that question. When you ask things like, or whenever a question arises like, is it better to buy this or better to buy that? I don't know. It depends on you. What are you trying to get done? What are your circumstances? What are your goals? What's your risk tolerance? Everything is individual, right? There's no one answer that is perfect for everyone. That is the right answer for absolutely everyone. I wouldn't even begin to know how to answer the question for you. I can only answer it for me. When you sell puts, do you still sell them in pairs? Agencies 9.15, you sell 30 puts at 9. That's sometimes. Sometimes it depends on the skew on the index, right? So if you have very little skew, if it looks like this, well, there's very little value in doing that. But when you have a high level of skew, suddenly going a little bit deeper, you're not making a lot of premium, but you're getting paid a lot because the intrinsic value is much higher. Would you be confident in Canadian apartment REITs if they didn't have to keep a certain amount of your capital in Canada? I don't have to keep a certain amount of my capital in Canada. I have illiquid holdings that unfortunately have to stay there till I can take them out, but I don't have to keep money in Canada, but I do have Canadian dollars, so I may as well put those Canadian dollars to use. How do you value an ETF like XHB? An ETF is simply the weighting times the price, whatever price there is on that asset. So if it's 10%, it's just the sum of all of that. An ETF has no financial statements. It is simply just the net asset value of the components that it holds. If you were in Costa Rica, hypothetical question. Well, I am in Costa Rica. Do you think you would still be successful? It depends on where I was born. Just wondering because I do find you quite successful. I was born in South America and feel we have less of a chance of success. Well, you're right. Not putting excuses, but even in Europe, earning more than 5 to 6K a month is difficult. What would you say in that case? Create your own business? Pretty much. Pursue opportunities in other countries? Well, for something like Costa Rica has a structural problem, right? Is that you have a level of corruption that is from the top down. And with that level of corruption, there are times where you can't get something done even if you want to get something done. There are opportunities that are simply just blocked to you unless you're from the right family. Or unless you know somebody, or unless you've paid somebody to do something for you. So if you're born in a one of the family, to parents who are working class, and you don't make a lot being working class here, it's unlikely that you'll get much higher than that unless you're really gifted in something. But if you're just an average person hoping to eke out an average life here isn't that great simply because of the corruption. It is corrupt. It may not look that way when you first get here, but it is. Lying and stealing is not limited. In Canada, we find that most of that kind of activity happens at the bottom. Not that rich people don't steal, they do, but not to the extent that you would find it at the bottom because it becomes an economic necessity. Here, it's part of the culture. I've had a housekeeper who was stealing from me, and the person who I bought the house from is a doctor, by all means, financially successful, but a thief, a liar, a thief, and I am finding out now a fraudster. This is the culture that you come into. So when I see lefties screaming in America about the inequality, I think, yeah, but it's because it's your own fault. If you're unequal, it's kind of your own fault in those countries. It truly is, I think, a lot of personal responsibility, but not here. You want to get angry about inequality, it's in countries like this. Then I've said this before, that you would think that the U.S. would have some moral obligation to invade and remove the corrupt government and have some government that allows for social mobility, that finds these successful people in this country. And I wouldn't even call them successful. Here you can call them rich. because I don't think they earn their success fairly. You find these rich people and you charge them with crimes. And you force them to pay the taxes that they willingly don't pay, by the way. The person who owned this house before me had to pay a luxury tax, did not pay it because you have an inefficient system here. That is stealing from the people. You know, somebody who didn't have to, stealing from the people. When you start doing that in a country that is this poor, that makes you a rather disgusting human being. Right? When you really, really don't need it and you already have it really good and the tax rates are already really low, that you go out of your way to steal even more. That's cultural. That is cultural, and that keeps a lot of people down. Would I be successful if I was born here? Not as successful, no. I would have been trapped in poverty. I would have probably had to go to work out of necessity. Yeah, I don't think that I would have had the same chance in this country that I had in Canada. That does not mean I have privilege at all. It just means that I was born in a country with a moral center. I was born in a country that set up a system founded and guided by morality, but not here. Don't look for it here. You will be massively disappointed. Every day I have to keep reminding myself that I'm here for the taxes, I'm here for the taxes, I'm here for a short term, then I'm leaving, because it is quite exhausting on a day-to-day basis dealing with the culture. It is exhausting. But yeah, I think you're right. So you can sort of understand the migration that goes on from South America, Central America into the U.S. You can understand it because you can either stay here and live in structural poverty, and your kids live in structural poverty, not because you're too lazy, but because no matter what you do, you can't beat the corruption in the system. You cannot beat the corruption in the system. And if you point at somebody and say, that's a corrupt person right there in one of these families, you will get killed. You will lose your life, period. And everyone knows that, so nobody says anything, because you will lose your life. At that point, I think if I still had the mindset that I have, I still had the cognitive abilities I had, I think when I was 18 or 19, I would have ran very quickly for the American border. I would have been out of here because I would have seen it as a dead end, and I would have ran. But, you know, here we are. I agree with you. Born in South America and feel we have less of a chance. Well, you're right. You probably do. You probably do. How often do you check in on the performance of external managers? Every year. You can't judge them based on, like, you have to judge them based on the plan that you set. So if you set a plan for your external money saying, look, this has to be safety money because this is money that's going to be that I'm giving away at some point in the future. I'm not investing it for me. I'm investing it for the future organizations I'm giving it to. You have to have a plan that is sensible for that, and you have to judge the performance based on that plan. So you can't say, well, the market was up 20%, but you weren't. The answer would be, yeah, but we're not in the market. We're in a lot of this other stuff. We're targeting a 6.5% return. You got to judge us based on the 6.5. Okay, you did 7.5. The market did 20, but we're not in the market. We're not holding a market portfolio in that sense, right? 10Ks. Notice there are concepts in financial statements that I know I've learned in L1 and L2 but forgot. In that respect, is it a good idea to read the whole CFA curriculum? No, just you look up what you need. You just look up what you need, that's all. I know this is a quick review, but to guess future cash flows or earnings, do I use G equals RR retention rate and to forecast sales? I can use Uh, I'm going to pass on CFA questions here. What are the odds AI boosts productivity enough to get us out of the deficit hole? What deficit hole? Which of the deficit holes are you referring to? For example, cost savings from labor. Well, I know what productivity is, but I don't know what deficit hole. Do you mean government deficits? No, that's not going to happen. That's a function of stupidity. Not AI is not going to fix that. If you could shed some light on this topic, the Fed are in a similar situation like BOJ and they will decrease the funds rate to zero. What will happen to the status of the US dollar as a reserve currency? It's a reserve currency because of the sheer size of it, because of the liquidity of it, because of the safety of the US government. That's what makes it a reserve currency, not because of the interest rate on it. How much importance do you attach to the rate of change when looking at data like GDP in Canada? How much importance do I attach to the rate of change? That seems like a pretty abstract question. Versus what? How much importance do I attach to it versus what? What else would you look at? I mean, when you're looking at GDP growth, you've got to look at the rate of change in real GDP. Like growth is a rate of change. I don't know. Yeah, I'd have to say, well, versus what? Like, give me an alternative. Versus what? Have you experienced in higher education? Is the international students at Canadian universities a source of funding? And if so, is the income generating a meaningful amount used to subsidize Canadian student, or is that hui? No, they pay full pop. They pay they pay everything, whatever the cost of having them there. They pay that full cost, whereas a Canadian student does not pay the full cost. They are in part subsidized by the taxpayer. What would have to happen for you to change your mind on long TLT? You seem convinced rates must drop, but could they stay higher for longer? Nope. Oh, they can. There could be perfect intentions on keeping them higher for longer, but external events happen. External events will happen, and these rates will begin to have their effect. They will begin to have their effect, and there will be. It's hard to predict an external event, but if you keep these rates at these levels and you adjust to these rates, that means there's less money. If you're paying more in interest expense over time, there's less money for anything else. It will end only in one way. Okay, purpose of assigning par value to the additional equity shares issued by a public company and recording par value as the newly issued shares separately from the additional paid in capital. Can it be done as one line item? Doing it at one line item, what you're going to end up having is a different price for the same security, a different value for the same security. So a company is authorized to issue a certain number of shares, and it has to have some value. There has to be some value for it, but they can all be sold at different prices. So it would just confuse a bunch of things as to what was the par value, what was the additional paid in capital, versus what is the retained earnings. When a company buys back shares, it doesn't just come out of retained earnings. There is the par value, there's the additional paid in capital, there's retained earnings. So when it buys back shares, let's say, the proportional amount comes out of the paid in, out of the par value. It also comes out of the paid in, and only what is left over comes out of retained earnings. Because if they're buying back shares at the value of the paid in capital and the par value, then you haven't reduced retained earnings at all. But because they're all bought at different prices at different times, you're going to have some way of accounting for that difference, right? So that's why it goes into a different holding account, paid in capital. Is there any type of forward futures market for mortgage rates? Yes, there is. Also, when you say that U.S. will need to cut rates because of its debt, wouldn't lowering rates increase the present value of their existing debt, thereby increasing the? It doesn't matter. The U.S. does not buy back its bonds. The debt is not listed at fair market value. The debt is listed at face value. So whenever a bond is issued, it's issued at par, right? And the rate at which, the yield at which the auction clears becomes the coupon. So it wouldn't change anything. The interest on the debt is not based on the market price of the debt. It's based on the face value of the debt. Good knowledge in analysis techniques, but I don't know how to start. I feel lost through all these, integrating economy with sectors to create a context, same as financial analysis techniques. We start with something small. You start with one thing. If you're looking at a company's 10K, go to the balance sheet and say, that's all I'm going to do. I'm just going to stick with the balance sheet and I'm going to know it. And then I'll move to the income statement, then I'll know that. And eventually, in understanding the balance sheet, you will have had to read all of the notes to the income statements, cash and cash equivalents, note 1. So you go to note 1 and you read that, you see some words you don't understand, you Google them. And you just keep going like that. And you just keep going and you tear it down little by little by little. You take a big thing like the 10K and you say, all I care about is this paragraph. That's all. I'm gonna spend all my time knowing this paragraph. When I know it, I'll go on to the next paragraph. And in time, you'll know it. It just, you have to start somewhere. Still think the Bank of Canada lowers rates in June? I do. Okay, I answered this one. What do you believe the key to success is for retail investors? Patience, education, and patience. Retail investors tend to overtrade. Patience. How do I choose a sector to be an expert in, as you've mentioned lately? What do you like? Right? What do you like? I actually think of tech as it will be promising in the future. Or this is not the case. I don't know. You tell me. But I think this sector is very volatile. Who cares? Who cares if it's volatile? Doesn't, I mean, that would be like saying I don't want to go to school. I don't want to go to school and major in finance because because there's some stocks that are too volatile. Who cares if they're too volatile? You're not investing in it. You're getting to know the sector. You don't have to pick the volatile component. Tech is big. There's lots of companies in tech. Just pick something. Something you like, something you enjoy. Otherwise, it won't be enjoyable. Once you understand something, it becomes easier to figure out where the trade happens to be. Is Tesla brand strong enough to withstand a price war and incentivize buyers to stay? Oh, yeah, they got a brand. I mean, that question sort of. It's too big and abstract a question to say, you kind of trying to answer everything all in one small question. I don't know how you could answer that one. It's not a well-structured question. There could be, I don't know, 50 people could read that question. You get 50 different answers on that one. It's not focused enough. What is it you exactly want to know? This is sort of a question that says, I want to know absolutely everything in one small sentence. And I don't know that there's an answer that would answer the question the way you want it answered. Autonomous vehicles are decades away in the future. I'm curious if you could give more explanation why I already did that. Negative retained earnings concern for equity investors? Not really. No, it just means that something in their past caused retained earnings to be negative, and we don't buy the past, we buy the future. Negative retained earnings with a dividend is non-taxable because that is simply return of capital. Assume a stock is trading its fair value of 100. Company has revenue go to 2%, cash flow margin 20%. Assuming all factors remain the same, will the stock keep trading at 100 indefinite? I don't know. I don't know. I don't think that's nearly enough information. I can think of 50 different questions based on this scenario. You know, a fair value of 100 based on what model? Based on what kind of discounting? 20% cash flow margins. What are they doing with that cash? You can't keep building up cash over time. The more you build up cash, the more your ROE will drop. So, I mean, yeah, this scenario is just not enough. That's not enough for me to get any kind of information in at all, unless it's a question from a model in a purely theoretical way. Then I would say, you got to give me the rest of the sentences that went around this. In what context am I answering this? Under what theoretical lens am I looking at this? What was the academic setup in the book before you got to this statement, right? But just to pull it out of its context and throw it out in the world, I don't know, beats the hell out of me. I don't know. Is there a back of the envelope calculation? I don't know. No idea. Ultra wealthy people have too low a tax rate? No, I think they have too high a tax rate. You tell me. When I was in Canada, I had a 53.5% tax rate. 53.5, that is federal and Ontario together. And then if I bought any vehicle over 100,000, my sales tax was 33%. 33% sales tax. And now they want to move the capital gains inclusion from 50% to 66%, but only if you make more than 250K in capital gains. 53.5, we're going to punish you if you try to spend money. If you try to make more money, we're going to punish you as well. Now, you tell me. You think I'm not paying enough tax? Are those tax rates too low? No. Tax rates are way too high. So what do? We look for ways around those tax rates because they are unfair. If there was a flat tax of 40%, just 40%, or even your upper tax is 40%, after you pay your tax, you're free to spend your money as you see fit, I never would have left Canada. I would have thought, well, that's fair. It's high, but it's fair. But it's 53.5, it's 33% sales tax, it's a higher capital gains inclusion rate, and they will not stop there. They will not stop there. It's going to go even higher. It's past the point of fair. It's completely unfair, but it won't stop there. The wealthy people in Canada are the horses on Orwell's Animal Farm. We are the horses, and we are expected to perform. Well, we got 4 legs, right? We can walk away. And so that's what I did. Let's see. Okay, those are just comments. Do you see credit ratings easing as a result of low productivity and current and potential future capital net out? Credit ratings easing? You mean dropping? Credit rates dropping? Credit ratings on what? On the country of Canada? I don't know. In time, I mean, if this continues on, low productivity, and you have a government that continues to deficit spend and scare capital away, at some point the finances are going to become unsustainable and there will be a credit downgrade, sure. Do you see a time when Tesla gets squeezed out of the car market? No, I see a time. Tesla's not in the car market right now. If you talk to any Tesla shareholder, they'll tell you Tesla's not a car company, man. It's a software company. No, it's an AV company. No, it's an AI company. No, it's an energy company, but it's not a car company, man. No, I see a time when Tesla will be squeezed into the auto industry, and they will have auto industry margins like everyone else, and they will be like everyone else, and they will have multiples like everyone else. Tesla will not get squeezed out of the car market. As much as they want to not be a car company, they are a car company. When 87% of your revenue comes from selling cars, you are a car company, no matter what you're working on. But they're working on self-driving. So is every car company. So is every car company. You know, they have EVs. So does every car company now. So does every car company. And in China, the other car companies are beating Tesla. You know, so anything you can say about Tesla, you can say about every single car company out there, but you know what they are? Car companies. They're all car companies. Tesla will not be unique. It will not be a software company in the auto industry. If that's the future, all car companies will be software companies in the auto industry, hence being in the auto industry. They will get squeezed into the auto industry. They will have auto industry valuations. And that's it. You've got the union momentum. Competitors are slowly catching up. Not slowly catching up. There are competitors that have exceeded Tesla. And in fact, on everything that you can say, Tesla's here, Tesla's there, there's at least one car company in the world that's better than them at it. There's not one company that's better than Tesla on everything, but there's at least one car company in the world right now that's better than Tesla on everything you can point out about Tesla. There's a car company that's better. So it's not that they're catching up. They have exceeded. And they will continue. They will continue that. Maybe they turn into simply being a software robot company. No. Providing service to car makers. Not owning Tesla. They would have to split into two. I'd assume this would be much better in terms of margins. It would, but they would have to split into two for that. This is the case of Pepsi. When Pepsi owned restaurants, what Pepsi found was, hey, if we own restaurants, they'll serve Pepsi. So I think they had Taco Bell, KFC, and what else did they have? Taco Bell, KFC, and they had 3 restaurants. I forget which 3 they had. It was a while ago. And Pepsi owned them. But if you want to go to McDonald's, McDonald's would say, why would we ever buy from Pepsi when you own our competition? Why would we ever do that? So suddenly they couldn't get enough market share with Pepsi. They divested the restaurants, realizing that no other restaurant is going to buy from them when they own the competition. So they had to divest. So if I was a car company and Tesla said, we'll license our full self-driving to you, I would think, why would you license me the best quality? You're going to keep the best version for yourself, and I'll have something less. I can't, and you're going to collect data on my driver. I doubt it. I don't think so. You're my competition. Why would I ever get that from you? Especially something critical like that. Charging infrastructure, sure, I don't care about that, but something as critical as this, no thanks. Tesla would have to split into two. Short delta, no, already answered that. Buying TLT, waiting for interest rates to drop. That's what I'm doing. What are the risks? Underperforming. Do you think future rate cuts already priced in TLT? No. No. And that's it.